Your market news now. Asian stocks stumbled after China delivered a smaller cut to lending rates than markets had counted on, continuing Beijing's run of disappointingly frugal stimulus steps. Rather disappointment at the meager move saw the Chinese blue chips ease about 0.4% to their lowest level in almost 9 months. Meanwhile, oil prices edged higher, having snapped a 7-week winning streak as concerns about Chinese demand offset tight supplies. Locally, coal miner Curro Resources has announced a 69% slide. That's in interim profits on the back of lower prices and rail constraints. Interim profit fell to 3 billion rand as the group battled a significant decrease in thermal coal prices. The interim dividend was also cut to 10 rand per share, or around 1.4 billion rand, and that was down from last year's 60 rand per share. However, the share price was a little bit up, but another company that also reported earnings was Curro, and we're going to be getting into that discussion with Gary Boyson from Rand Swiss. Gary, thank you so much for your time. Let's start off with, some of the market sentiment. I know this week we are looking forward to the Jackson Hole Economic Symposium. And in previous years, this symposium has always been an indicator of what policy changes, or at least what concerns a lot of the economists, including the Fed. So how are you reading market sentiment right now?
So it's interesting. It's a little bit of a difficult day to read because we had obviously the announcement of Chinese stimulus this morning. It was seen as not enough stimulus. So we had the Hang Seng on the back foot, yet we've got most of the European markets as well as the S&P futures actually positive. The JSE is up nicely, as I'm sure you've taken the viewers through. The financials are leading the upside, so we're up over 2% on the financial index. And I think markets are largely shrugging it off. We've got oil prices a little bit higher. We saw the essentially exports to China from Saudi Arabia slipping. We also saw a drop in the rig count by the Baker Hughes survey on Friday. So, we're seeing oil prices a little bit higher, but you just get the feeling that this is Northern Hemisphere summer. It's choppy trade, up a little bit, down a little bit. I mean, resources were up strongly this morning. They've moved back to flat. So it's all over the place at the moment.
All right, I mentioned to the viewers that apart from Curro Resources having released their results, we also had numbers coming out of Curro, and they're reporting that the average number of learners rose 3%, and this is in the interim period. What were the takeaways for you as you look at those figures?
I think the major takeaway is that the private sector can deliver where government is not delivering. So what you see here is 5.5 billion rand JSE listed company that is effectively servicing 72,385 learners and supplying very, very good educational services. From everything we can tell, the families and the learners are happy. It's creating jobs for teachers, and shareholders should be happy with the returns they're seeing at the moment. So in the results, the headline earnings per share were up 36%. This is for the 6 months to the end of June. No dividend was declared, but that is, I don't think that was large. That wasn't really unexpected. And they have committed to pay out around 20% of the headline earnings per share. So we'll probably get that in the full year numbers. But that 30% rise in headline earnings per share, right in the middle of guidance. So no big surprises to the market, and the stock taking the update in its stride.
If we're to compare this one and Stdio, does the market have a favorite, or how's the market feeling about the education space, and perhaps even you as well?
Well, it's a good question. So remember, Stdio and Curro used to be the same business, and Stdio unbundled from Curro. So both ex-PSG stable companies. Stdio obviously just focusing on the tertiary education space. Curro kind of taking care of the rest. So it's a difficult question. We hold Curro in portfolios for clients, but we like Stdio as well. The analyst that covers it for us, Stdio is his preferred pick. So both I think very, very good quality companies, just servicing different segments of the market.
Let's stay locally. What would you say, or rather, which are the SA stocks that you'd say have held up really well against this economic background, and rather that have actually been resilient, to say?
So it's been a very difficult period, I suppose. We've had COVID, we've had Ukraine wars, we've had all sorts of things. So if you go back and just look at, let's say, share price performance over, let's say, 3 and 5 years, If you look at 3 years, Thungela is one of the best performing stocks. As you mentioned, we had results today, and you might have revenue down 45%, but that stock over the last 3 years is up a whopping 850%. We've seen that kind of theme playing through after the Ukraine war, that a lot of the commodity counters had that incredible lift as prices increased, and they've really acted as a counterbalance in what has been a difficult couple of years for equity investors. If you go out to 5 years, the best performing stocks are actually the gold companies. So you've got the likes of Gold Fields up around 520%. You've also got Sibanye-Stillwater up around 270%, and Harmony up about 200% over 5 years. So that's where you would have found safety over a period where we had the drawdowns like COVID, where you've had Ukrainian wars, where you've had rising interest rates. That's really been your defensive plays. But I think I have to say to viewers, investing in equities is about a portfolio approach. It's about having a little bit of everything. And to go piling into these stocks at this stage maybe is not the right way of thinking about it. And if you look at over the same period, the biggest losers, it's actually been the property market. So property has been under enormous pressure, specifically South African property. We see it in all the REITs that are listed on our exchange. But that could just mean that property is starting to present some value. We're obviously in an interest rate hiking cycle where we seem to be getting towards the top of it. And you generally find property markets will perform better as interest rates get cut. So before you go and pile into those traditional defensives like gold, you might want to consider maybe just having a look at the property market again.
With that said, then, if you had to rate your clients on a sentiment scale here, where is it sitting? Are they, cautious, or are they bullish and they want to actually take more risk?
That's a very difficult question, because we essentially run across 3 different businesses. So we've got a securities broking business, which is largely self-directed, and there, clients, to try and find the center of mass of those clients is very, very difficult. Everyone has their own opinions, everyone is expressing their own views. But certainly in our managed products, so that's our managed portfolios and our wealth management business, I think in the managed portfolio section, we've really seen an increase in the demand for capital protected products. We feel that the clients are definitely becoming a lot more cautious. We've seen this big run up in stock markets, and anything that can offer them a degree of capital protection on the downside has really been popular. At the same time, in our wealth business, that we can really tell, I suppose, if there's confusion out there in the market, because the more people that require wealth managers, it just generally tells me that there's a lot of uncertainty around. And at this stage, our issue is unfortunately that we can't find the skilled wealth managers. There's too many people looking for services. So clearly, I think investors at this stage, looking at where the markets are, looking at what we've been through over the last couple of years, looking at, I suppose, general equity performance over 5 years, and really looking for a little bit of assistance. So I would say cautious. I would say in general the clients that we're dealing with are maybe more cautious than they normally are.
All right, Gary, let's leave it there. Thank you so much for your time. That is Gary Boyson from Rand Swiss. And speaking of Thungela Resources, even though they have reported a 6.6 billion rand plunge in profits, that share price is up 4% on the day for now. However, let's leave it there. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.